Hello everyone, this is Prateek. I'm presenting to you a series of videos which explain to you what exactly is an investment banking. The videos that you will see after this clip would be the live sessions that I take at Visenius. You will get to hear all the interactions, all the interesting concepts, the discussions that we usually have at Visenius in these live sessions. So yeah, go through all the videos. It will give you a very practical idea about what investment banking is, how deeply it is rooted to the basics of finance. I'm going to start this series with this very first video, which talks about the different sources of capital and how it is connected to different investment banking job profiles. So see you there.
Let's start by a simple question. Okay, let me put up a very simple question before I get into the details of what investment banking is all about. I'm asking you a simple question. Which are the different sources of capital for a company? A simple question that if a company wishes to raise capital, okay, which are the different avenues through which a company can raise funds from? What are your thoughts, people? What do you think? What is your answer? Which are the avenues through which a company can raise money?
Either debt and equity.
Debt and equity. Yeah. People don't write in your comments. I am focused on my screen, so I will not be able to read them. Speak it out. Okay. I am getting the answer. It's debt. It's equity. Any other answers? Anything else?
Honest capital.
Honest capital, or I can say internal accruals.
External sources could be like through via venture capital or private equity.
Can I say that venture capital, or let's put this color green. Venture capital, PE, IPO, FPO, rights, private placement, they more or less fall under equity mode of fundraising. Can I not say that? Do you agree with me on this? What happens here? You're raising equity from these external sources. Yeah. And what is the basic funda of this fundraising via the equity route? The basic fundas are simple. You get the money by selling off a stake in your business. Can I not say that? You're diluting some bit of ownership in your business. You must have seen Shark Tank. You must have seen at least some advertisements, if not the entire episode of shows like Pictures, Shark Tanks, where what happens there? There are a bunch of founders who present a product, who present a service in front of few sharks. Who are these sharks? These sharks are the venture capitalists. They are the investors. The idea is simple. They will pitch the product and they will say that we need, let's say, $5 million of funding, and we are willing to dilute or give up an ownership of 10% stake in our businesses. So the promoter or the founders are giving up a portion of their business in exchange of the funds. Yes or no, people? Do we agree to this? Do we understand this? Yes, no?
Yes, sir.
Everyone with me? Yeah. So that's the basic fundamental of the equity funders. What about debt? What about debt? Or are there, coming back to my first question, are there any other avenues through which a company can raise funds from? Anything that you guys can think of? Anything else? Anything else?
Friends and family, sir.
Sorry? Friends and family?
Friends and family.
Okay. Yeah, sure. What else? What else? Think, huh? Think about some sectors, think about some different areas. Anything? Can I not say government grants? Specifically, there are certain sectors in which government gives you grants, subsidies, tax reliefs. Yeah, it is applicable in sectors like pharma, infrastructure, biotech, any sector which has to, there will be some more. Any sector which has to do with the nation building activity. Okay, where let's say in case of corona situation, governments across the globe came out and supported pharmaceutical companies. They said that okay, you perform your research and development on the probable vaccinations. We will help you, we will support you, we will give you tax release, we will give you funding if you guys require this, but come up with something that saves the population. Similarly, in case of if you're setting up a office in certain zones where government wishes to promote employment, they will give you tax reliefs. There are SEZ, special economic zones, is what they call. They will give you subsidies, they will give you tax reliefs, so that you are encouraged to set up your manufacturing unit or a facility there, so that the local people get employment. So in a way, government grant can also be classified as one of the sources of funds, though not applicable to all the sectors, but yeah, it is there. Yeah. And when it comes to banks, when it comes to debt, so your primary funding comes from banks, uh, probably public debt markets. Yeah, we call them the bond markets. Yeah, we have NBFCs. We also may have HNIs who may give you debt. No, these are basically the unsecured sources. Banks are your secured lending sources. NBFCs, HNIs are your unsecured sources. What do I mean by secured and unsecured? Can you even tell me? What are secured sources? What are unsecured sources? People?
Sir, collateral and non-collateral
All right. What is collateral? What is non-collateral?
means we give our asset on the behalf of our loan. That is called a secured loan.
Mhm. You
And
get
unsecured is like,
you get a loan where
yes,
you need to pledge something. You need to give a mortgage or a collateral. Yes or no?
yes,
Mortgage or collateral. Then asset is given as on the basis of a mortgage or a collateral. In this, you are not required to pledge anything. Required to give a collateral. Guys, I would appreciate if you take the notes simultaneously. These are all the things that will help you eventually prepare yourself for the interviews. Okay, I'll be discussing all the points that will be useful to you in your interviews, in your discussions, or help you add points to your answers in your interviews. So keep noting them down wherever you feel like. Another peculiarity is that the rate of interest is relatively lower compared to secured. You agree with me?
yes, sir.
Others, I need answers, people. We cannot be on mute. Do you guys agree with me on this? Interest is higher. So what happens is unsecured sources, because you are not keeping anything as collateral, the lender is exposed to a higher risk. Like what happens if you default? So to make up for that extended risk or higher risk, what they do is they charge a relatively higher rate of interest compared to secure. And typically banks offer you this type of secured loans, and here typically it's your NBFCs and HNIs or probably some individuals or other sources which give you these type of unsecured loans where you're not required to keep anything as a collateral. Imagine now, visualize that. Okay.